All right, people, let's talk taxes. Nobody likes them, everybody's got to pay them. It's the price we pay for civilization, or so they say. But what if I told you there's a new sheriff in town, a digital detective sniffing out tax dodgers with the precision of a bloodhound? Enter the tax accounting equation, or TAE for short. Think of it as a lie detector test for your finances. You see, in this age of globalization and digital finance, things are getting complicated. Money moves faster than ever, crossing borders with a few clicks. And where there's money, there's always someone trying to hide it from the taxman. That's where the TAE comes in. It's a powerful tool that helps us understand how companies account for their taxes in this brave new world. But it's not just about catching the bad guys. The TAE can also help businesses stay on the right side of the law. It's like having a financial advisor whispering in your ear, "Hey, that deduction might raise some eyebrows." In a world where tax laws are more complex than ever, the TAE is a beacon of clarity, shining a light on the murky depths of corporate accounting. So buckle up, folks, because we're about to dive deep into the world of the tax accounting equation. We'll explore its components, its applications, and its potential to revolutionize the way we think about taxes in the 21st century. Now, I know what you're thinking. Hassan, you had me at digital detective, but tax accounting equation. That sounds about as exciting as watching paint dry, but trust me on this one. The TAE might sound intimidating, but at its core, it's a pretty simple concept. Think of it like this. The TAE is an equation that helps us understand the relationship between a company's accounting profits and its taxable income. It's like a set of scales, with one side representing what a company tells its investors and the other side representing what it tells the tax authorities. On the accounting profits side, we have things like revenue, expenses, and assets. This is the information companies use to paint a picture of their financial health to the public. On the taxable income side, we have things like deductions, credits, and you guessed it, taxes. This is the information companies use to determine how much they owe Uncle Sam. The TAE helps us connect the dots between these two sides of the equation. It looks for discrepancies, inconsistencies, and red flags that might indicate tax avoidance or even outright evasion. It's like a financial forensics team, analyzing the books to see if everything adds up. In the next few sections, we'll break down the key components of the TAE, from deferred tax assets and liabilities to the mysterious world of digital markers. So grab your calculators, folks, because things are about to get numerical. Remember those old detective movies where they dust for fingerprints at a crime scene? Well, the TAE is kind of like that, but instead of fingerprints, we're looking for digital markers. These are like breadcrumbs left behind in the digital world that can reveal a company's true tax position. Think about it. In today's digital economy, almost every transaction leaves a digital footprint. Online purchases, international wire transfers, cryptocurrency trades, it's all recorded somewhere. And these records can be a goldmine for tax authorities looking to crack down on tax avoidance. For example, let's say a company claims to have made a huge sale to a subsidiary in a low-tax jurisdiction. That might sound legitimate on paper, but the TAE can help us dig deeper. By analyzing digital markers like IP addresses, transaction timestamps, and even the language used in emails, we can start to get a clear picture of what's really going on. Is the subsidiary actually a shell company with no real business operations? Are the sales figures inflated to artificially reduce the company's tax burden? The TAE can help us answer these questions and more. It's like having a team of digital detectives combing through a company's digital footprint, looking for clues that might indicate tax shenanigans. And the best part? As technology continues to evolve, so too will the TAE, becoming an even more powerful tool in the fight against tax avoidance. Now let's talk about one of the sneakiest tricks in the tax avoidance playbook, revenue reclassification. This is where companies try to make their profits appear in low-tax jurisdictions, even if the actual economic activity took place somewhere else. It's like a magician making a rabbit disappear. Except instead of a rabbit, it's millions of dollars in tax revenue. Here's how it works. Imagine a multinational corporation that sells smartphones all over the world. They manufacture the phones in China, sell them in the United States, and then here's the kicker. They report the profits in a tax haven like the Cayman Islands. How do they do it? Well, they might set up a subsidiary in the Cayman Islands and then route all their profits through that subsidiary, even though the subsidiary doesn't actually do anything. It's just a shell company, a phantom entity designed to avoid taxes. This is where the TAE comes in handy. By analyzing the company's financial statements and looking for inconsistencies between their reported revenue and their actual economic activity, the TAE can help us identify potential cases of revenue reclassification. It's like following the money trail, except instead of dusty old ledgers, we're using sophisticated algorithms and data analysis techniques. And trust me, when it comes to tax avoidance, the devil is always in the details. Section 5. Simulating tax evasion. Because nothing says fun like spreadsheets. All right, folks, time to get our hands dirty with some good old-fashioned data analysis. Remember those digital markers we talked about earlier? Well, to make sense of all that data, we need to use some pretty sophisticated tools and techniques. One of the most powerful tools in our arsenal is simulation. By creating computer models of different tax scenarios, we can test out different hypotheses and see how the TAE performs under different conditions. It's like running a virtual experiment, except instead of test tubes and beakers, we're using Python, Pandas, and NumPy. For example, let's say we want to see how effective the TAE is at detecting revenue reclassification. We can create a simulation where we have a hypothetical company that's trying to shift its profits to a low-tax jurisdiction. We can then feed the company's financial data into the TAE and see if it's able to detect the tax avoidance scheme. We can even run sensitivity analyses to see how the TAE performs under different assumptions. What if the company is more sophisticated in its tax avoidance techniques? What if the tax laws change? By running these simulations, we can fine-tune the TAE and make it even more effective at detecting tax avoidance. It's like having a crystal ball that allows us to peer into the future of tax enforcement. And while it's not perfect, it's a powerful tool that's helping to level the playing field between tax authorities and multinational corporations. Section 6. Data everywhere, but not a drop to drink sometimes. Now, before we get too carried away with all this talk of digital detectives and crystal balls, we need to address the elephant in the room: data limitations. As much as we love data, the reality is that it's not always perfect. Sometimes it's incomplete, sometimes it's inaccurate, and sometimes it's just plain missing. Think about it. We're talking about collecting data from all over the world, from different companies in different formats and subject to different accounting standards. It's a logistical nightmare, even with the most sophisticated technology. For example, let's say we're trying to track the flow of money between a parent company and its subsidiaries. We might have data on the parent company's financial transactions, but what about the subsidiaries? If they're located in jurisdictions with weak financial transparency laws, it might be impossible to get our hands on that data. And even if we do have all the data, it's not always reliable. Companies can make mistakes intentionally or unintentionally, and sometimes they even cook the books to make themselves look more profitable than they actually are. So what's the solution? Well, it's a combination of things. We need to improve data collection methods, standardize accounting standards, and strengthen financial transparency laws. But most importantly, we need to be aware of the limitations of data and use it responsibly. Section 7, the taxman's canary in the coal mine. Remember those canaries that miners used to take down into the coal mines to warn them of dangerous gases? Well, the TAE is kind of like that, but instead of detecting methane, it's detecting tax avoidance. It's an early warning system that can help tax authorities identify potential problems before they become major headaches. Think about it. Traditional tax audits are reactive. They happen after the fact, after the damage has already been done. But the TAE allows us to be proactive. By analyzing data in real time, we can identify red flags and potential risks before they turn into full-blown tax scandals. For example, let's say a company suddenly starts reporting a significant increase in profits from a subsidiary in a low-tax jurisdiction. That might be a sign that they're engaging in revenue reclassification. The TAE can pick up on this anomaly and alert tax authorities, who can then investigate further. This early warning system is crucial in today's fast-paced global economy. By the time a traditional tax audit is completed, the money might already be gone, hidden away in some offshore account. But the TAE gives tax authorities a fighting chance to catch tax dodgers in the act. It's like having a team of financial watchdogs constantly monitoring the markets, sniffing out suspicious activity and barking loudly when they find something fishy. And in the game of cat and mouse between tax authorities and multinational corporations, every second counts. Section 8, from fintech to e-commerce, the TAE's digital domain. Now let's talk about where the TAE really shines, the digital world. In today's digital economy, more and more transactions are happening online, from e-commerce to fintech to cryptocurrency. And this digital shift presents both challenges and opportunities for tax enforcement. On the one hand, the digital world makes it easier than ever for individuals and companies to move money across borders and hide it from tax authorities. But on the other hand, it also creates a wealth of data that can be used to track those movements and identify potential tax avoidance. This is where the TAE comes in. It's specifically designed to analyze digital data and identify patterns and anomalies that might indicate tax avoidance. For example, the TAE can be used to track the flow of money through online payment platforms, identify suspicious transactions on cryptocurrency exchanges, and even monitor social media for evidence of tax evasion. In the world of fintech, the TAE can help regulators ensure that new financial products and services are not being used for illicit purposes. In e-commerce, it can help level the playing field between online retailers and brick-and-mortar stores. And in the world of cryptocurrency, it can help shed light on the shadowy world of anonymous transactions. The TAE is like a digital Swiss Army knife, capable of adapting to the ever-changing landscape of the digital economy. And as the world becomes increasingly digital, the TAE's importance will only continue to grow. Section 9, Beyond the TAE, the future of tax enforcement. So there you have it, folks, the tax accounting equation, a powerful new tool in the fight against tax avoidance. But the TAE is just the beginning. As technology continues to evolve, so too will the methods used to detect and prevent tax avoidance. In the future, we can expect to see even more sophisticated algorithms, more comprehensive data analysis, and greater international cooperation between tax authorities. Artificial intelligence and machine learning will play an increasingly important role in identifying patterns and anomalies that might indicate tax avoidance. We might even see the development of a global tax enforcement agency equipped with the latest technology and empowered to crack down on tax havens and multinational corporations that try to game the system. But technology alone is not enough. We also need to address the underlying issues that make tax avoidance possible in the first place. This means closing loopholes, strengthening financial transparency laws, and promoting a culture of tax compliance. The fight against tax avoidance is a marathon, not a sprint. But with the help of tools like the TAE, we can level the playing field and ensure that everyone pays their fair share. Because at the end of the day, taxes are what we pay for a functioning society. And in a world facing unprecedented challenges, we need all hands on deck.